You ever feel like day trading is this mysterious game where some people make huge profits, but whenever you try, you either freeze, overtrade, or blow up your account? Here's the truth. The problem isn't your ambition, it's your foundation. Most beginners jump in without knowing the steps, and that's why they fail. But the good news? If you take the right steps, learning how to begin properly, practicing with paper trading, and understanding how much capital you actually need, you set yourself up for success while avoiding the traps that wipe out most newbies. Back-end index pointing right, so stick with me until the end of this video. By the time we're done, you'll know exactly how to start day trading the right way. And if you're serious about leveling up, make sure to hit that like button, subscribe, and drop a comment, because this channel is all about helping traders like you win consistently. How to begin? Day trading isn't about guessing or finding that one magic indicator. The very first step is education and structure. Start by learning the basics: how candlesticks work, what price action means, and how to read market structure. Think of this as your trading map. You don't need 20 different indicators. What you need is context. Indicators can help confirm, but they can't replace understanding the natural rhythm of the market. Focus instead on learning how markets move: trends, ranges, breakouts, and reversals. If you try to trade everything, you'll learn nothing. So pick one or two markets, like stocks, forex, or crypto, and study them deeply. Build a simple trading plan with clear entry and exit rules. Without structure, every trade feels random. With structure, you shift from gambling to professional decision-making. Now, here's where most beginners go wrong. They try to copy strategies they find online without really understanding why they work. A better approach is to study one pattern at a time. For example, focus on a basic trend-following setup. If you see the market forming higher highs and higher lows, you might plan to enter after a pullback to a support level. By repeating this one process, you start to understand not only the setup, but also the psychology behind it. Buyers pushing price up, sellers taking profits, and then buyers stepping back in. Another powerful step is journaling. When you first begin, write down every trade idea, even before you take it. Record why you would enter, where you would exit, and what risk you take. Then, review it later against what actually happened. This process trains you to think in probabilities instead of emotions. A journal is like a mirror. It shows you your strengths, weaknesses, and patterns you might not notice in the moment. Here's a simple example. Imagine you're watching Apple stock. The price has been climbing for several days, making higher highs. You notice a small pullback. It taps a previous support level. Instead of jumping in blindly, you wait for a bullish candlestick to confirm buyers are stepping back in. You set a stop loss just below support and a target at the previous high. This isn't gambling. This is a structured plan with logic, risk control, and context. That's the mindset you want to build from the very beginning. Paper trading, practice without risk. Once you build a basic structure, resist the urge to throw your hard-earned money into the market right away. This is where most beginners fail. They skip the practice stage and dive into live trading too soon. That's like trying to fly a plane without ever using a flight simulator. Paper trading gives you the chance to practice in real market conditions without financial risk. But here's the catch. If you treat your demo account like a video game, you'll waste the opportunity. You need to treat paper trading as seriously as if it were your actual money. Create a daily routine, set a trading plan, and stick to it. If you blow up your paper account by being reckless, you won't magically become disciplined with real money. The habits you form here carry into your live trading. Another benefit is tracking and testing strategies. In paper trading, you can run experiments safely. Try a breakout strategy, test a pullback setup, or even practice risk management rules. Over time, you'll see which approaches fit your personality and risk tolerance. You're not just testing the market, you're testing yourself. Imagine you're practicing on Euro to US dollar and Forex. You've decided on a simple rule: only trade when price breaks out of range with strong volume. On demo, you take 10 trades in a week, all following this rule. You win 6 and lose 4. Your journal shows that your winners were bigger than your losers, giving you a positive expectancy. That's a system you can refine and later take live with confidence. All because you practiced first without risking a dime. Required capital: start smart, not big. Now let's talk about money, the part that makes or breaks new traders. One of the biggest misconceptions is that you need a huge account to start day trading. That belief causes two dangerous behaviors. Either people don't start at all, or they start by over-leveraging small accounts and blowing them up. The truth? You don't need a fortune to begin. You need the right mindset and smart risk management. If you're trading US stocks, you'll face the pattern day trader (PDT) rule, which requires $25,000 to day trade freely. That sounds intimidating, but it doesn't mean you're shut out. Many beginners instead start with swing trading or use futures, forex, or crypto markets, which allows smaller capital requirements and fewer restrictions. The key is to pick a market where your account size matches the rules and volatility. What matters more than size is how you manage each trade. The golden rule is to risk no more than 1 to 2% of your account on a single position. If your account is $1,000, your maximum loss per trade should be $10 to $20. That may feel small, but it protects your capital while you learn. Day trading is not about making one massive win. It's about compounding small, consistent gains over time. Let's say you have $2,000 to start with in a Forex account. You decide to risk 1% per trade. That's $20. You identify a setup where you can place your stop loss 20 pips away. With that, you size your position at $1 per pip. If the trade works and you capture 40 pips, you've doubled your risk and made $40. Repeat this process with discipline, and your account can grow steadily without the emotional roller coaster of risking too much too soon. So here's the takeaway. Learn the basics and build structure. Practice with paper trading until you're confident. Start small with the right capital and manage risk like a pro. If you stick to these steps, you'll separate yourself from the 90% of beginners who fail because they skip the fundamentals. If you found this helpful, don't forget to like this video, subscribe to the channel, and drop a comment letting me know where you are in your trading journey. Thanks for watching, and remember, successful trading isn't about luck, it's about preparation and discipline.